Hey everyone, it's Don Harkins with your Florida House Team and your Florida Loan Team. We are here in the first week of February. The real estate market continues to evolve, continues to change a little bit, and I wanted to make sure everybody was up to speed. After watching this video, I think you're going to have a great idea of exactly what's happening with inventory levels, exactly what's driving the market, what to expect as far as interest rates go in 2022, and also what to expect as far as prices go. In fact, you will probably be better informed about the market than your realtor or your closest real estate friend is by the time we get through some of this information. So I'm looking forward to sharing this with you. As always, we are a full service real estate team. So if you do have questions about home prices, or if you do have questions about financing, if you're thinking about listing your home, or if you're thinking about making a purchase, please reach out to us. We've got a great team of agents who are ready to help out with any of your real estate needs. So moving right into the data, one of the first things we're going to talk about today is something we haven't discussed recently, and that is homeowner tenure, how long people are staying in their homes. Historically, when we look back, this data began being collected in 1985 by the National Association of Realtors. But when homeowners were surveyed, on average, they were staying in their home for about 6 years. And that was the average for a long time. And then in 2009, 2010, obviously coming out of the financial crisis, people started settling in and staying in their homes a little bit longer. Part of the reason was they were just starting to grow equity. And we've seen that number continue to grow and stay strong, where most recently homeowners have been staying in their homes for about 9 to 10 years. And that's been pretty consistent over the last decade. We just saw the largest year-over-year change in that data coming down, where homeowners are now moving or staying in their home for about 8 years on average. So part of that means that if you've been in your home a long time, your needs are just changing. Another part of the reason for that is we're starting to see homeowners have so much equity, it's a lot easier for them to be mobile and get into different properties, relocate to a different area, or find something that better, or I should say purchase something that better meets their needs. So that number is coming down. We'll keep a close eye on it to see if it comes down again next year. But for right now, homeowners are staying in their home for about 8 years. By the way, we think that 6 year to 8 year difference, 6 year to 10 year difference reflects some pent up seller demand. So there's probably a lot of homeowners that have been thinking about moving the last 2, 3, 4 years, but everything happening with COVID, run up in prices, people have been kind of sitting on the sidelines. So we may start to see not only the first-time home buyers or entry-level home buyers in the market this spring and summer, but we also might start to see some of these homeowners who've been sitting on the sidelines, sitting in their home for that 7th, 8th, 9th, or 10th year. We might start to see them come back into the market. I wouldn't be surprised if we did. Speaking of equity and the equity homeowners have, we are still seeing a surge in home equity growth. So when we compare quarter 3 of 2021 with quarter 3 of 2020, we saw the average homeowner across the nation had an increase in their equity of $56,700. But here in Florida, Florida real estate outperformed the national average by about $8,000. So the average homeowner in Florida saw a $64,000 increase in their home's equity between quarter 3 2021 and quarter 3 2020. That's a combination of home price appreciation, but also principal pay down. Some people also refinanced and lowered their payment while still maintaining that rate of principal pay down. So we saw a 31.1% year-over-year percentage increase in equity for U.S. homeowners with mortgages, a tremendous increase. $3.2 trillion year-over-year total increase in equity for all U.S. homeowners. So real estate being a wealth creation tool, it is undoubtedly the largest wealth creation tool for U.S. average working class people. And so we're really happy to see all that wealth in the hands of the average homeowner. This past summer home price growth reached the highest level more than 45 years. We've talked about that a lot. So we have both the principal pay down portion, low interest rates are allowing people to get into paying down that principal faster, but we also have that home price increase, which is really fueling this number as well. Talking about price increases, we have to talk about inflation. Everyone's talking about inflation right now. It's absolutely running rampant. We are seeing sometimes just knee-jerk prices increased by 25% in some of the construction trades. So we're seeing that not only in the tools and products and materials that those people are using, but also in the labor itself. Really nothing's being spared. So while prices are up, obviously investors and homeowners, average people alike, should be looking for hedges against that inflation. And we have a good comment from a financial writer, Mark Cusson, who's a really notable financial writer with Investopedia. What he says is real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. So more specifically, as prices rise, so do property values. And I want to show you this graph here, which is really interesting. It looks at the past few decades along with the past 2 years side by side to see just how well real estate hedged against inflation. You can see even when inflation was soaring in the 1970s and 1980s, real estate still either kept pace or even outpaced as a great inflation hedge. So right now, if you're starting to see your investment power erode, or you've got a lot of money sitting in the bank and you're worried about your money losing value as inflation surges, reach out to us. There's still great investment properties available. We're not going to touch on rent increases in this video. We've talked about it in some of our last videos. But despite prices increasing, rents are rising faster than home prices are. So if you are thinking about investing in real estate, there's still some good opportunity out there for you. Looking at mortgage rates and how mortgages impact the inflation hedge. Fixed rate mortgages allow you to maintain the biggest portion of the housing expense, the principal and interest portion, at the same payment level. So property taxes will rise, and we are going to need to address property taxes because as values have nearly doubled in the last 7 to 8 years, so have tax revenue. And we need to, as citizens, start reaching out to our tax collector's office, to the property appraiser, looking at our assessed values, looking at what that property tax bill is, and questioning whether or not these local taxing authorities still need to be bringing in the same rate on our properties to provide services that they have been. So as property taxes will rise, insurance is rising in Florida. We're one of the worst markets for insurance, which, by the way, we've recently made a fantastic contact on the insurance side of the business. Personally, the person we've been working with shaved my personal homeowner's insurance bill down by 66%. And we had to make a couple very affordable modifications, but we have an opportunity to speak to hundreds of homeowners insurance agents, and we've got a really great contact. So if you'd like an assessment or evaluation on your current policy, reach out to us for that info. But obviously, if you're renting, there's no stopping these increases. These increases are going to occur. If you get into a mortgage, you're able to fix that principal and interest portion. You're able to get some affordable insurance locked in, then you're really only subject to the increases in taxes, which in Florida, at least on a homestead property, we can cap at a 3% year-over-year increase. So definitely a good hedge as far as that goes. When we look at over time, we can look at the core inflation rate versus rental price appreciation. This is one of the things that's really unfortunate is rental price appreciation actually outpaces inflation. So right now we're seeing rents increase even faster than this massive increase in inflation. So tenants are not only paying more at the pump, paying more at the grocery store, paying more for regular goods and services, they have to pay even more for their housing expense. So it's going to catch up with us, especially middle class and lower class who don't have access to home ownership. This is going to be an issue. So if you are waiting for prices to come down or waiting on the sideline, just understand you're getting squeezed from two directions. We'd like to help you get into a house and at least get that principal and interest portion of your payment fixed in. Natalie Campisi, who is on staff at Forbes, she had a great quote: homeowners are shielded from mounting rental prices because their cost is fixed regardless of what's happening in the market. Tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend money during inflationary times. And we couldn't agree more. driving home this point, if you have cash and are expecting inflation, you want to think through where you can put your money so it does not lose value. Housing is commonly looked at as a good inflation hedge, especially with interest rates so low. That's from Ali Wolf, chief economist at Zonda. Zonda, if you haven't heard of them, they're a really great housing data research firm that a lot of people in the industry subscribe to get raw data translated and graphed out into a really usable format. So check them out if you're curious about learning more, diving deeper into these numbers. So if we look at where we're going, the home price expectation survey, which is a survey which is performed on a quarterly and annual basis, just came out with 2021 quarter 4 results, and we grouped these people, or I should say the survey grouped these people into optimists, pessimists, and all the panelists surveyed. And the optimists over the next 4 years through 2026 or by 2026 are expecting house price appreciation to be as high as 62.5%. An incredible number. That's an incredible wealth building opportunity, especially when you consider your payment is staying the same, but your asset price may double. The optimists are saying as high as 62.5%. The pessimists are saying still 23%. That's still a 5-6% gain annually over the next 4 years, which by any measure is a solid gain. And then when we take an average of the full spectrum, 43.3% expected appreciation by 2026. So it's not looking like, if you are sitting on the sidelines, it's not looking like home prices are likely to come down for you anytime in the near future. When we look at mortgage rates, will mortgage rates come down at all? We have some good data that just came out from Freddie Mac on rates I wanted to share with you. Sam Cater, who's their chief economist, had a good quote. Following a month-long rise, mortgage rates effectively stayed flat this week. Finally, they've been on a tear. Recent rate increases have yet to significantly impact purchase demand, as history demonstrates that potential home buyers who are on the fence will often enter the market at the start of rate increase cycles. So what's that saying basically is, as rates start to rise up, it oftentimes pushes people off the fence into the market. So we may even see a spike in demand as rates rise. Don't expect rising rates to hamper demand too much. That can have an inverse effect, especially at the beginning of the cycle. Of course, as we get further and further into the rate increase cycle, we may start to see a bigger impact on demand, but it's not likely to happen anytime soon. And right here you can see, as of last week, the most recent data we have, the 30-year fixed rate average was 3.55%, with average fees or points at 0.7. So the way points work, what this is basically saying is, if you were taking out a $400,000 mortgage, on average last week you locked at 3.55%, and if you paid 0.7 points on a $400,000 mortgage, you're paying about $3,000, give or take, to access that 3.55 rate. So when you're looking at mortgages in this rising rate environment, you're probably going to be looking at a combination of down payment, closing costs, and then points, discount points that you're going to be paying. As we get further into the rate increase cycle, we'll start to see sellers offering to pay discount points to buyers who are looking to purchase. As inventory rises, sellers will be using that as a tool to entice buyers to choose their home over competing property. I wanted to show you guys this graph from Freddie Mac data that shows we're basically sitting back today where we were in February of 2020. So right before the pandemic started, right before all the quantitative easing, right before all the Fed and stimulus action, which pushed rates down so far below that 2.7 mark, we were sitting here right around the 3.5 mark in February. So we saw a great 2-year period of opportunity for people. Now we've seen that opportunity kind of wane, and we're right back to where we were at the status quo, 3.55. We showed a historical interest rate graph on the last video we did, so if you want to go back and check that out, you'll see 3.55, if we take a big picture look, is still really a fantastic rate for all things considered. Looking at where rates are heading, this is very difficult to predict, especially when an event like COVID or an event like something that's happening with Russia-Ukraine can impact markets so heavily and send rates all over the place. But When we look back for the last 50 years, the 30-year mortgage rate moved in almost perfect unison with the 10-year Treasury rate. And so you can see here from 1972 to 2021 how those rates really moved together. This is the 10-year Treasury yield today. We're looking at data from December of 2021, and this is daily data from Macro Trends. And you can see the 10-year Treasury is on the move right now, but the mortgage rate really has not followed has not followed in line quite as perfectly as what we see here. So there may be some lag in increasing interest rates that's going to come. At the same time, we have started to see the interest rates start to move up. So we're looking at probably seeing this trend continue. And if you're looking for an idea of where mortgage rates are headed rather than asking somebody to guess, a better option might be to follow that 10-year Treasury yield. Flipping over to home price appreciation or home price acceleration, the rate of appreciation, well, it does appear that acceleration has started to peak. So that doesn't mean we expect that prices will come down, but it means we expect the pace of price increases to either stay static or start to come back down at some point. So we just looked at through 2026 at least. We're still expecting very robust price gains, but the pace of gain, it does appear, at least looking back over the last 9-10 months, that we're starting to see, according to FHFA, CoreLogic, S&P, Case-Shiller, their data, it looks like we're starting to see the pace of that acceleration start to level off. Taking a shorter term view, what are we expecting for 2022? We've shown this data a little bit. We've kind of been looking at a 4% average. Now we're starting to see a 5.1% average. Some estimates are as high as 12% for home price growth in 2022. I really hope that doesn't happen, but what we're seeing as far as multiple offers, inventory levels, demand levels right now, I wouldn't be surprised if we even outpaced this 5.1% estimate for 2022. Closing up, Deputy Chief Economist for First American, a major national title company. House prices and existing home sales have historically been resilient to rising mortgage rates. Definitely true. Andy Walden, who's VP of Market Research for Black Knight, a really large, well-respected real estate data aggregation company, said as COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans. And I wanted to show you guys this graph. If you're looking for distressed inventory, if you're looking for auction properties, if you're looking for foreclosure properties, now's a great time to stop looking for those. They are just simply not coming anytime soon. Not with the amount of equity we see, not with the amount of demand we see, not with the low inventory. And this should really be the nail in the coffin for these people who have been talking about the wave of looming foreclosures or the shadow inventory foreclosures coming. You can see here that we are now at a 2-year low for number of loans in active forbearance. When we look at how people came out of those, about half of them actually sold the property, paid the loan off in full. About another third of them worked out some sort of settlement plan. And only about 16% of people that came out of forbearance were still at risk of continuing to have some difficulties over time. Looking ahead and kind of summing up all this, CoreLogic, great data research firm for real estate data. They have a senior leader of research who's a great resource for us. She says, so overall, I do think that 2022 will be another strong year for housing, albeit a little bit higher mortgage rates. And we do think home sales will continue to rise and actually reach a 16-year high in 2022. So Mayclair Bolton Smith saying that. And the reason I put that up there is we sort of echo her viewpoints on things. We're gearing up for a really busy spring and summer season. We're already starting to see more homes coming on the market. We're already hearing from buyers who've been in their home for 1 year, 2 year, 3 year, who are looking at getting into something that better meets their needs today. So if your home isn't currently meeting your needs, don't hesitate to reach out to us. We can find you properties off market that are going to be a better fit for you. You can still access very affordable interest rates like you just saw around the 3.5% mark. And you can obviously list your current home if you do own a home and really enjoy a great number of offers and great convenience in selling the property. Thanks for taking the time to watch. I know this was a little bit long, but we had a lot of info to catch you up on. Hopefully it was helpful. Don't forget to visit yourfloridahousesearch.com and yourfloridaloanteam.com for all your real estate and mortgage needs. I'm Don Harkins, and have a great week.